today I'm going to give you an update on everything that has happened recently in the stock market and what I think is going to happen tomorrow as well as into next week. We got a lot on the calendar. We did have that sell-off in the middle of December, and since then we've been kind of stuck in this range here on the S&P 500, just chopping around this 381 level, which is significant because it is the drop of 20% from all-time highs, which is a technical bear market line. So you can see down here it's right around 20% in the middle of this range. And we've just kind of chopped around there a bunch of times. Obviously, we broke it in June. Then we pushed to the upside. It acted as support, broke down below it again. And so far, we've just been chopping up and down on this 20% line. So it has been a key level. I do want to see us break out of this level at some point. If I do look at the NASDAQ, this is about 35 to 36% below all-time highs. So right now, tech is leading us to the downside, which is kind of expected. You've seen a lot of layoffs here in tech. You can go to layoffs.fyi and see that just recently we had Amazon and Salesforce lay off 8,000 each. Amazon laid off 10,000 a little bit earlier, so a total of 18,000. Genesis was this crypto firm, laid off 30% of their workforce, only 60 people, but this is a useful website. You can see what's happening, especially if you work in the tech industry. I think this is useful. I do expect at some point you'll probably see layoffs in other sectors, and so really time will tell, but I do think the U.S. economy is headed into a recession, and I'm really looking to play short in this type of market. Obviously, once things look oversold and way overextended, there's always going to be a bear market rally. You've seen this time and time again where we've had these really strong pushes to the upside. And I do think, if we do break down below into new territory here, if I was looking at tech, I'd be looking at this previous high from right before the COVID crash, which is at 237, 238. That will most likely act as a decent level of support, and I'd like to go long around that range. So you got to really be patient when you're looking at these setups. Small caps, these circles here signal the 200-day moving average on the white line, and we rejected that twice so far this year. Now we're kind of chopping around in this range. This is a pattern that has played out so far this year. We'll have these push to the downside, we'll consolidate, push downside, consolidate, push down. Sometimes we'll have a bounce, consolidate, then we've rejected. But each time we've made these local highs, so especially right here. Let me just clean this up here for a second. So you can see these local highs will drop, and then we'll consolidate and then drop again. And it's kind of happened so far this year multiple times. I do expect this pattern to play out. Now we do have jobs data coming out tomorrow. So we have unemployment as well as participation rate and on-farm payrolls. These are all before the opening bell tomorrow. So depending on which way this goes can have an influence on if we break out of this range, either to the downside or the upside. If unemployment rate is low, then that's bearish for stocks because the Fed can keep rates higher for longer, as well as if payrolls are above this. If it's really essentially if pay and jobs are hot, then the market should sell, and vice versa. And then next week we do have CPI, and this is kind of the same logic. If CPI is still high, so if inflation is still high, above this 6.7%, above expectations, that's bearish for stocks. If it's below, that's bullish. Even if it is bullish, I do think at some point, say we do push to this upside and test this trend line again, if we start to see some candle close rejections here, so you see some rejection candles, I do expect that will come back down. So this would just really prolong us going back to lows. I do think that these lows will be tested or even broken at some point in the first quarter of 2023. So that's something to look out for. That's what I'm going to be looking to play. If I look at Apple, this is an interesting setup. So I do have the volume profile here. You can see there's a pretty big gap if we ever do break down below 107, even around this 115 level. The 200 weekly moving average is right around 114. So that might also act as support, but if that breaks, it does get really ugly. anytime so far on any of these big large caps if we ever broke the 200 weekly moving average. Now I do expect Apple to find some support here around 123, 125. It did break that low before from June, so we might have some bounce or some consolidation in this range. If we do break below this though, I'm really looking at that 115, so right around the 200 weekly moving average, to take profit on the puts that I bought around 145, 150. So that's really it for Apple. Just be careful there. I do think that Apple and tech will probably bottom around the same time. Apple is the largest stock in the S&P 500, so that's something to try to time. Another thing I wanted to cover is just what I think is going on with the overall economy. These are some useful indicators. The Warren Buffett indicator, this is total US market value. So the total value of all stocks relative to GDP, which is 26 trillion. If you divide 41 divided with 26, you get 158%. And this chart shows a historical trend of the indicator. And as you can see, anytime we've gone well above the mean, 2 standard deviations, the dot-com bubble, didn't quite make it there once we recovered before 2008, and then when we were well below the historical average, and then we've pushed up in a 10 to 12 year bull market. Obviously we had the COVID crash when the economy was at a standstill, and then we've had this push to the upside and a correction to the downside ever since. Will we come back and retest this historical trend? I personally think we will, as long as the Fed is continuing to keep rates at a high level and tighten the balance sheet. And then the Shiller PE ratio, this is similar to Warren Buffett's indicator. This measures price to earnings on a 10-year inflation adjusted EPS. And it's at 27.85. The best way you can just interpret it is that when PE is really high, stocks are overvalued, and vice versa. And as you can see here, the mean value historically has been around 16 to 17, so we're still well above that mean. So that might change over the coming year. Another interesting thing to point out is just the total debt relative to gross domestic product, which is the market value of all goods and services produced. And you can see here that this has just gone up over time. So we do have a lot of debt in this country. You can see the total debt here and gross domestic product over time. So this is really financed by how much debt we've been taking out. And obviously the more debt you have, the more at risk you are at defaulting on your payments. And so that's just something to look out for as well. That's it for this video. Hope you appreciate it, and I'll see you in the next one. I'll probably put one out tomorrow for the weekend. Peace.